So mortgage rates are finally starting to taper back downwards again. It's been a wild 2022, and 2023 is shaping up to be just as interesting or even more interesting. We saw a downward trend of mortgage interest rates in the last quarter or so of 2022 that was really interesting to witness. After a significant bump from the Fed's rate hikes in about February of 2022, we saw interest rate peak at double or a little above double what they were in just January of 2022 by about June or July of 2022. And by the time we got to the end of the year, we started to see rates get back down in the 5-ish to 6% range, which was significantly down from the deep 7% range we were starting to see over the summer of 2022. So mortgage rates are starting to trend downward. Housing affordability is starting to tilt back in the favor of buyers. But does that mean that mortgages are going to be easier to get? Maybe not. In this video, we're going to talk about it. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and owning more real estate. I want you to like this video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So if homes are becoming more affordable again because interest rates are starting to taper down, then why would they still be challenging or potentially even be more challenging to get approved for? Well, you can't pop champagne bottles just yet because rates may be tapering back down. There are economic levers being pulled that are influencing interest rates in the mortgage market to drop. I spoke on it in a previous video that even though the federal funds rate is increasing steadily, it is not the main driver or predicator of mortgage loans. The 10-year treasury actually has a deeper impact on mortgage loans than the Fed's fund rate. The demand from investors buying mortgage-backed securities, these things affect mortgage rates much more significantly. And right now, those things are functioning in a way that's actually bringing mortgage rates back down. So if the mortgage rates are dropping, that makes more home available to you to purchase, or at least from a financing point of view, becomes more affordable. Then what is it that can turn out to be in the way in you getting approved for financing in the first place? Well, you have to keep in mind, the Federal Reserve and the government are actually still in a very, very heated firefight with inflation. They're looking to cool off the economy, and they're looking to cool down the housing market especially. We saw nearly a 40% increase in home valuations in the 2020 through 2022, around 2021 in particular, nearly 40% in many markets. This is insane. The Federal Reserve and the federal government are well aware for the long-term health of the housing market and the economy as a whole, that inflation at near 10% and housing prices increasing 30+% per year is absolutely unacceptable and absolutely unsustainable. So with this in mind, if the Federal Reserve can't control mortgage rates directly with the federal funds rate, you have to believe that they're going to continue to push policies and sentiment that will roll out into the economy and roll out into the housing market. So when you start to see lenders increasing their underwriting standards in some form of fashion, enforcing underwriting guidelines that may not have been enforced in the past, and then just overall tightening of who they're lending to, then you have to keep in mind that this is all in the backdrop of extremely high inflation and an extremely hot housing market that's taken a while to cool down. So what's the most significant value out of this video that you can gather? What you need to understand is that you're going to need strong financials. There are many programs out there to help for down payment assistance, closing cost assistance, so on and so forth. There are a lot of programs, and states are rich with cash right now to try to entice people to purchase homes. So it's a little bit against the federal objective of the government on state levels. That having been said, that doesn't necessarily mean that you need to go into your home purchasing process financially ill-equipped. You need to be in a strong place financially. Lenders are going to want to do business because that's how they make money, but they're also influenced by the Federal Reserve, by the federal government's policies. And if cooling down the housing market is an objective, then they may be forced or coerced into tightening their lending standards in some form or fashion. This could be increasing the credit score limits on certain loans. This could be increasing other underwriting standards. This could be increasing the DTI demand. There's so many other ways they can pull levers and squeeze borrowers to try to thin out the herd so they can start slowing down the housing market for a healthier economy. So that just because housing may be becoming affordable again for some of you doesn't necessarily mean that the lending standards are going to get any easier in the next coming years. Remember, we're in an economic contraction right now. So that means that you can expect it to be harder to get access to capital. Financing for homes is no different. So I wanted to put this on you guys' minds. Those of you who have not bought a home yet, but were in the market in the 2020s, you're still on the fence. Those of you who are looking to invest in rental properties and may see some shifts in guidelines in that arena. Anybody from home for primary residence, owner occupied to investment properties, you need to keep your head on straight about the economy that we're in and entering in the coming years. Lending standards may get tighter. They will likely get tighter. So don't think because rates may be getting cheaper that it's going to be easier to get a loan. Stay focused, stay in motion. I'll see y'all soon.